Almost every country in the world carries debt. The United States owes trillions, Japan owes trillions, even small nations carry large balances on their books. When you first hear that, a simple question forms in your mind. If everyone owes money, who is actually getting paid? It sounds like a riddle, and in a way it is. Most people picture government debt as money borrowed from some powerful outside force, a foreign bank, a rival nation, some shadowy creditor waiting to collect. That image makes sense. It feels intuitive, but the full picture is more interesting than that. In most cases, the largest creditors are not foreign at all. They are domestic, banks inside the country, pension funds holding the savings of ordinary workers, insurance companies, central banks. Sometimes the citizens themselves buying government bonds directly. The debt is real, but it often circulates inside the same society that created it. Understanding how that works and why it works that way takes us back a very long time. Long before modern banking existed, rulers needed money, wars were expensive, building projects drained treasuries, and tax collection was slow, seasonal, and unreliable. So rulers borrowed. In ancient Mesopotamia, temples acted as financial centers. They held grain, silver, and surplus goods. Rulers could draw on those reserves in times of need. The temple expected repayment. The relationship was practical on both sides. In medieval Europe, wealthy merchants and trading families filled that role. The Bardi and Peruzzi families of Florence lent enormous sums to European kings in the 14th century. When Edward III of England defaulted in the 1340s, those Florentine banking houses collapsed. The lesson was painful and clear. Lending to rulers carried real risk, but lenders kept lending. Why? Because rulers had something merchants needed: legal authority, military protection, access to trade routes. A king who repaid his debts was a king worth doing business with again. The relationship between ruler and lender was never purely about money. It was about access, protection, and long-term advantage. Tax systems made it more stable over time. When rulers could demonstrate a reliable income, collected taxes, customs duties, revenues from land lenders had something to evaluate. Predictable income meant predictable repayment. That was the beginning of what we would later call creditworthiness. The real transformation came in the 17th century, and it started in a small country. The Dutch Republic at its peak in the 1600s was not the largest or most powerful state in Europe, but it was exceptionally well organized. Dutch merchants had deep experience with finance. The Amsterdam Exchange Bank, founded in 1609, became one of the most trusted financial institutions in the Western world. It brought order and standardization to a chaotic system of currencies and credit. Dutch provincial governments issued bonds. Ordinary citizens bought them. Wealthy merchants bought them. So did civic institutions and trading companies. The debt was spread widely across Dutch society. And because so many people had a financial stake in stable government, they supported the institutions that made repayment possible. Trust and self-interest reinforced each other. This was something new. When England looked to finance its own wars and ambitions, it studied the Dutch model carefully. In 1694, the Bank of England was founded. Its original purpose was straightforward. It would lend money to the government in exchange for a royal charter and the right to issue banknotes. The government got funds. The bank got legitimacy and privileges. Both sides had reasons to make it work. The bank then sold shares to private investors. Those investors became creditors to the state. Parliament, which controlled taxation, provided the institutional guarantee that debts would be repaid. The whole structure depended on parliamentary authority over public finances. That was the key innovation. Debt was no longer just a personal promise from a king. It was a commitment backed by an institution with legal and political power. This attracted domestic investors at scale. London merchants, landowners, and early financial firms bought into government debt. They were not doing charity. They were seeking a safe, reliable return. Government bonds paid interest. They were liquid, meaning they could be sold if needed. And they were backed by the most powerful financial institution in the country. The debt grew, but so did the investor base that held it. This pattern, governments borrowing from domestic institutions and citizens, repeated across many countries and many centuries. It was not an accident. It followed a consistent logic. Governments need funding beyond what taxes immediately provide. Domestic investors need somewhere safe to place capital. When political institutions are stable and tax systems are functional, a bond market can connect those two needs. Both sides benefit. Trust is the foundation, not trust in a vague or emotional sense. Structural trust. Investors need to believe that the legal system will enforce the terms of the bond, that the government will not simply cancel the debt, that inflation will not silently destroy the value of their holdings. When those conditions exist, domestic markets absorb government debt willingly. Tax capacity matters just as much. A government that cannot collect taxes reliably cannot credibly promise future repayment. Lenders, foreign or domestic, watch tax systems closely. A strong, consistent revenue base is essentially the government's credit rating in historical terms. Institutional stability reinforces both. Parliaments, central banks, independent courts, these structures exist partly to make government commitments believable over time. When investors know that a promise made today will be honored 10 or 20 years from now, they will accept lower interest rates. That is why institutional development and debt markets often grew together. Financial markets completed the system. A bond that can be sold to someone else is far more attractive than one you must hold to maturity. When bond markets developed places where government debt could be traded, domestic investment deepened. More people could participate. More capital could flow toward government borrowing. Each element reinforced the others. These patterns did not stay in 17th century Europe. They echoed forward through history, showing up in different countries at different times. In 19th century Britain, the national debt accumulated through decades of war was held largely by domestic bondholders. Wealthy families, financial institutions, and the Bank of England itself held large positions. Repayment meant transferring money from taxpayers to bondholders, many of whom were members of the same propertied class that shaped tax policy. The system was self-contained in a way that was rarely discussed openly. In the 20th century, war financing showed the same logic in a different form. During the First and Second World Wars, governments in Britain, the United States, and elsewhere launched large-scale war bond campaigns. Citizens were encouraged, sometimes pressured, to lend money to their own governments. The debt was domestic. The creditors were ordinary people. The message was patriotic. But the financial structure was classical. Japan in the late 20th and early 21st centuries became one of the clearest examples of domestically held sovereign debt. For decades, Japanese government bonds were purchased primarily by Japanese banks, insurance companies, the postal savings system, and the Bank of Japan itself. Foreign holdings remained relatively small. The scale of debt was enormous by any measure. But because it was held domestically, the dynamics were quite different from a country dependent on foreign creditors. These cases do not all work the same way. The consequences differ. The risks differ. But the structural pattern is recognizable. Domestic institutions absorb government debt because they have reasons to, not always for patriotic reasons, often practical ones. Regulatory requirements push banks toward holding safe assets. Pension funds need predictable long-term income. Insurance companies match long-duration liabilities with long-duration assets. Government bonds serve all of these purposes, and so the debt remains inside the country. So who gets paid when a country repays its debt? Often it is the same society that lent the money in the first place. Banks, pension funds, insurance companies, and central banks. Institutions that represent sometimes directly, sometimes indirectly the savings and financial interests of ordinary people. That does not make debt simple, or harmless, or trivial to manage. The way debt is structured, who holds it, and how it is repaid carries real consequences for different groups within a society. Those questions matter. But the image of a nation helplessly indebted to some outside power, while not always wrong, often misses the more common reality. Sovereign debt is frequently a transaction between a government and its own financial system. Public debt, at its core, reflects the internal financial architecture of a society. The relationship between what governments spend, what citizens save, and what institutions invest. It is a mirror of trust, structure, and shared interest, imperfect, complicated, and quietly central to how modern economies function. Governments and citizens are bound together through these financial systems in ways that are rarely visible, but they are always present. If you found this exploration worthwhile, consider watching it again with a specific country in mind. Notice who holds the debt. Notice who benefits from repayment. The structure tends to reveal a great deal.